Have you ever checked your bank account and felt this weird sense of relief? Like, okay, I've got $5,000 in there. I'm good. I can relax. But here's something that might shock you. That number you're staring at? It's not real. At least, not in the way you think it is. I'm not talking about some conspiracy theory. I'm talking about one of the most fundamental truths about modern banking that nobody ever explains to you. And once you understand it, you'll never look at your bank account the same way again. Here at Simple Money, we've spent years breaking down how the financial system actually works. Not how your high school economics teacher said it works. How it really works. And today, I'm going to reveal why that balance in your checking account is closer to a promise than actual money. Here's what's really happening every single time you deposit $1 into your bank. You walk in. You hand over your cash or deposit your paycheck. The teller smiles. Your account balance goes up. You walk out feeling good. You think your money is sitting there in a vault somewhere with your name on it, but it's not. The moment you deposit that money, the bank does something that would seem completely insane in any other context. They lend it out to someone else. Not some of it, not a little bit of it, almost all of it. Think about it this way. Imagine you have a coat check at a restaurant. People come in, hand you their coats, you give them a ticket. Simple system, right? Now imagine you take those coats and rent them out to other people while the owners are eating dinner. And you're not just renting out a few coats, you're renting out 90 coats for every 100 coats people gave you. That would be insane. That would be fraud. You'd go to jail. But that's exactly what banks do with your money. And it's not illegal. It's not even controversial. It's called Fractional Reserve Banking, and it's the foundation of our entire financial system. Now here's where things get interesting. The average person has no idea this is happening. You think your money is sitting in the bank, safe, waiting for you. But the bank only keeps about 10% of it on hand. The rest? Gone. Loaned out. Turned into someone else's mortgage, someone else's car payment, someone else's business expansion. Your bank account balance is really just an I.O.U. A promise that if you want your money, they'll give it to you. And here's the truly wild part. That system only works if everyone doesn't want their money at the same time. Because if everyone showed up tomorrow morning and said, "Hey, I'd like to withdraw my balance," the bank would run out of money before lunch. They literally don't have it. They can't have it. The system is designed so they don't have it. This isn't some flaw in the system. This is the system. Let me explain how we got here. Because understanding the history makes the present make a lot more sense. Hundreds of years ago, banks actually did keep your money in a vault. You deposited gold, they stored it, they gave you a receipt. That receipt said you could come get your gold whenever you wanted. Simple. But then some smart banker realized something. Most people don't come get their gold. It just sits there. So why not lend some of it out and charge interest? Make some profit on money that's just sitting there anyway. At first, this was conservative. They'd lend out maybe 20 or 30%. Keep the rest in the vault. Safe. But then they realized they could lend out more. 50%, 60%, 70%. And as long as everyone didn't want their gold back at the same time, nobody would ever know. This created something that sounds like magic. It created money out of thin air. Because now the person who deposited gold had a receipt saying they had gold, and the person who borrowed that gold had actual gold. The same gold was in two places at once, or at least two people believed they had access to it. That's fractional reserve banking, and we've been running this system ever since. Except now it's not gold, it's just numbers on a screen. Now let me walk you through what I call the multiplication trap. This is where things get really weird. Because it's not just your bank doing this, it's every bank. And the effects multiply in ways that are genuinely hard to wrap your head around. You deposit $100 in Bank A. Bank A keeps $10 and loans out $90 to someone named Jake. Jake uses that $90 to pay a contractor. The contractor deposits that $90 in Bank B. Bank B keeps $9 and loans out $81. That person spends it, someone else deposits it, and the cycle continues. $100 of actual cash just became 100, then 190, then 271, and on and on. Each cycle creates more money. Or more accurately, more claims on money that doesn't fully exist. By the time this cycle completes, That original $100 has turned into nearly $1,000 of total deposits across the banking system, 10 times the original amount. This is why economists say banks create money. They literally do, not by printing it, by lending it into existence. Now here's what makes this even more insidious. You're making financial decisions based on a number that represents a promise, not a thing. When you check your balance and see $5,000, you're not seeing $5,000 of actual currency. You're seeing the bank's promise to give you $5,000 if you ask for it, which they can do because they'll get that money from someone else's deposit or by borrowing it from another bank or from the Federal Reserve. It's a web of promises built on top of promises, built on top of a tiny foundation of actual money. The next thing that makes this system so fragile is what I call the confidence game. The entire system runs on one thing: confidence. Your confidence that when you want your money, you can get it. That confidence is the only thing standing between normal banking and total collapse. Think about what happens when that confidence disappears. It's called a bank run. And it's exactly what it sounds like. People run to the bank to get their money before it's gone. This happened all the time in the early 1900s. A rumor would spread that a bank was in trouble. Maybe it was true, maybe it wasn't. But people would panic and rush to withdraw their money. And because the bank only had 10% of deposits on hand, they'd run out of cash. And that would prove the rumor true, even if it started as a lie. One bank would fail. People would panic about other banks. More bank runs, more failures. It would cascade through the entire system. This is why we now have the FDIC, the Federal Deposit Insurance Corporation. They insure deposits up to $250,000. So even if your bank fails, you get your money back. The government promises it. But here's the thing. That's another promise built on top of the system of promises. The FDIC doesn't have enough money to bail out all the banks if they all failed at once. They have a fund. It's a big fund, but it's nowhere near big enough to cover every deposit in America. The FDIC works because bank failures are rare and isolated. The system works because we all believe it works. The moment that belief cracks, the whole thing becomes very fragile very fast. We saw this in 2008. Not a traditional bank run, but a crisis of confidence in the financial system. Banks stopped trusting each other. Credit froze. The government had to step in with trillions of dollars to keep the system from imploding. And here's what nobody wants to admit. It could happen again. Because the fundamental structure hasn't changed. We still have fractional reserve banking. We still have a system built on confidence and promises. Now let me tell you about what I call the digital illusion. This is particularly cruel because of how we interact with money now. You barely ever see physical cash anymore. Everything is digital. Numbers on a screen, taps on your phone. This makes the illusion even more complete. At least when banks dealt with gold, there was a physical thing. You could go look at it. It existed in space. Now, your bank balance is literally just data, a number in a database. When you transfer money, nothing physical moves. The bank just changes numbers, subtract from your account, add to someone else's account. That's it. This creates a weird psychological distance from what money actually is, which makes it even easier to forget that the number you're looking at is a claim on money, not money itself. And here's where this gets personally relevant. Most people optimize their entire financial life around that number on the screen. They check it constantly. They stress when it's low. They relax when it's high. They make spending decisions based on whether the number is big enough. They judge their financial health entirely by what that balance says. But that number is only meaningful if the promise behind it holds. And the promise only holds if the entire system of interconnected promises holds, which it does, until it doesn't. The fifth pattern is what I call the leverage paradox. Here's something that seems contradictory but is absolutely true. The fractional reserve system is both incredibly fragile and incredibly powerful. It's fragile because it's built on promises and confidence. One crack in confidence and the whole thing can crumble. We've seen it happen. It will happen again. But it's also incredibly powerful because of what it enables. All that money creation? That's not just theoretical. That's how businesses get loans to expand. How people buy houses. How the economy grows. Without fractional reserve banking, there would be way less money available to borrow, which means way less investment, way less growth. The economy would be much smaller. So, we're stuck in this paradox. The system is dangerous, but it's also the engine of modern economic growth. We can't abandon it without massive consequences. But we can't ignore the risks without inviting disaster. This is why understanding this matters. Not because you need to panic, not because you need to stuff cash under your mattress, but because you need to understand what your bank account balance actually represents. It represents a claim on a system. A claim that's good as long as the system is good. And the system is good as long as everyone believes it's good. But here's what nobody wants to admit. That's a much more uncertain foundation than most people realize. Let me tell you about Sarah. Sarah's a graphic designer. She's been saving for years. She's got $35,000 in her checking account. She checks it almost every day. That number gives her security, makes her feel safe. Sarah thinks about her money like it's sitting in a vault with her name on it. She imagines it there, physical, real, hers. When she makes decisions, she thinks, I've got $35,000. I can afford this. Or, I need to be careful because I only have $35,000. That number is her anchor, her reality, her sense of financial identity. But here's what Sarah doesn't realize. That $35,000 is a claim on a promise. The bank has maybe $3,500 of actual cash on hand from her deposit. The rest has been lent out. It's someone's mortgage payment, someone's business loan, someone's car financing. Sarah's sense of security is built on something much more abstract than she thinks, and that changes nothing about her day-to-day life, until it does. If there's ever a crisis, if confidence ever cracks, if there's ever a modern bank run, Sarah will be standing in line with everyone else, trying to turn her digital promise into physical reality. And she might be shocked at how difficult that becomes. Now let me tell you about Marcus. Marcus is a software engineer. He's got about the same amount saved as Sarah. $40,000 across a couple of accounts. But Marcus thinks about his money differently. Not because he's smarter, not because he's more paranoid, but because he understands what bank deposits actually are. Marcus knows his bank balance is a claim on a system, so he doesn't put all his claims in one place. He's got money spread across 3 different banks. He's got some money in treasury bills. He's got some actual physical cash at home. Not a huge amount, but enough to live on for a month if something weird happened. Marcus doesn't do this because he thinks the system will collapse tomorrow. He does it because he understands the system is built on confidence, and confidence can crack. Usually it doesn't. But when it does, you want to be prepared. More importantly, Marcus doesn't let that number on the screen become his entire sense of financial security. He knows it's one piece, one claim among many. Real security comes from understanding the system and not being entirely dependent on any single part of it. Here's what most people don't realize. The difference between Sarah and Marcus isn't about fear versus confidence. It's about understanding versus assumption. Sarah assumes the system works the way it appears to work. Money in account equals money in vault. Simple, safe, permanent. Marcus understands the system works through a complex web of promises that usually hold but aren't guaranteed. So he plans accordingly. And here's the thing. Both of them are probably going to be fine. The system probably won't collapse. Banks probably won't fail. The promises will probably hold. But the knowledge changes how you relate to that number on your screen. It changes how you think about security. It changes how you prepare for uncertainty. It's not actually about fractional reserve banking at all. It's about understanding the difference between what appears to be true and what is actually true. Your bank account balance looks like a concrete thing, a number, a fact, money that exists. But it's really a claim on a promise within a system that runs on confidence. That's not a value judgment. That's not saying the system is bad or broken. That's just what it is. And once you understand what it is, you can make better decisions about how to interact with it. You can diversify where you keep your claims. You can understand why having some physical cash makes sense. You can recognize that financial security isn't just about the size of the number on your screen. It's about understanding what that number represents and having backup plans. The people who weather financial crises aren't the ones with the most money. They're the ones who understand how money actually works, who understand the difference between liquidity and solvency, between claims and assets, between promises and guarantees. They're the ones who don't panic when things get weird, because they already knew things were weird. They built their financial lives with that knowledge baked in. This is why financial education matters. Not because you need to become an economist, not because you need to understand every technical detail of how banking works, but because you need to understand what's real and what's a shared hallucination we all agree to believe in. Money is a shared hallucination. We all agree these pieces of paper or these numbers on screens have value, and because we all agree they do have value, that agreement is what makes the economy function. Bank deposits are a shared hallucination within a shared hallucination. We all agree the numbers on our screens represent money. We all agree the banks will give us that money when we ask. And because we all agree, and because banks can borrow from each other and from the Fed, it works. Until enough people stop agreeing. Then it stops working very quickly. The fractional reserve system isn't a flaw. It's a feature. It's how modern banking creates enough money for the economy to grow. It's how credit exists. It's how businesses expand. It's how you can get a mortgage without the bank having every dollar sitting in a vault. But it only works because of confidence, because of belief, because of the promise holding. And understanding that gives you power. Not the power to fix the system, not the power to change banking, but the power to navigate it with your eyes open. You can still use banks. You should use banks. They're useful. They're mostly safe. They're insured. The system works. But you can use them while understanding what they actually are, what your deposits actually represent, what risks actually exist. You can keep enough cash on hand to handle disruptions. You can spread money across multiple institutions. You can hold some assets outside the banking system entirely. You can build financial resilience that doesn't depend on everything working perfectly all the time. The multiplication trap, the confidence game, the digital illusion, the leverage paradox. These aren't character flaws. They're features of how modern banking works. They're predictable patterns that can be navigated once you understand them. The question isn't whether fractional reserve banking is good or bad. It's both. It's powerful and fragile, useful and risky, the engine of economic growth and a potential source of systemic crisis. The question is whether you understand it well enough to make informed decisions about your own money. Because that number on your screen, it's not a lie, but it's not the whole truth either. It's a claim on a promise within a system built on confidence. And the more you understand that, the better equipped you are to build real financial security in a world where most of what we call money is really just an agreement we all made to believe in the same thing.